2026 is shaping up to be a powerful year for US equities, driven by fiscal stimulus, a broader profit cycle, and a re-leveraging corporate environment. The macro outlook confirms this thesis. We're seeing clear signs of a profit cycle that's widening well beyond the tech giants. Trailing 12-month earnings per share are on a solid upward trajectory, signaling robust momentum that can lift the entire market. Corporate America is also beginning to re-leverage, taking on debt not out of distress, but for strategic growth and investment, a classic sign of confidence in the economic future. Inflation is expected to moderate, and GDP growth will remain resilient. This backdrop is why Société Générale has planted a bold flag for the future. Their forecast calls for the S&P 500 to hit 7,300 in 2026, with earnings per share reaching an incredible $333 by 2027. This isn't just wishful thinking, it's a forecast built on two powerful, interlocking drivers. First, easing financial conditions, and second, a massive wave of fiscal stimulus coupled with the ongoing AI revolution. At the heart of this growth engine is a concept SocGen calls the One Big Beautiful Bill, or OBBBA. This isn't a single piece of legislation, but a convergence of 5 powerful fiscal pillars. Think of it as a nationwide upgrade. A huge capital expenditure boost is modernizing infrastructure. Defense spending is surging. Household consumption is being supported by increased disposable income.
Small businesses are getting the support they need to thrive, and a pragmatic energy policy is driving investment. This translates directly to corporate revenues. The sectors set to benefit most are the ones doing the building: industrials, materials, energy, and select consumer names. These are the companies at the core of the OBBBA investment basket. Now let's talk about the second engine, the AI boom. It's easy to be skeptical and call it froth, but the data tells a different story. This is a boom underpinned by real fundamentals. Tech Capex to sales ratios are soaring as companies pour money into building out AI capabilities. The hyperscalers are maintaining incredibly strong EBITDA margins, proving this is a profitable enterprise. And most importantly, credit spreads remain tight, showing there's no underlying financial stress. The market is financing this boom with solid balance sheets, not speculative debt. This AI investment cycle has a long runway, with momentum expected to carry straight through 2026 and 2027. So what about valuations? Yes, the S&P 500 is expensive by historical standards, but SocGen's valuation scorecard argues this premium is justified by the sheer force of the coming earnings growth. In this environment, the risk premium offered by equities make them a far more compelling asset than credit.
The potential for earnings surprises to the upside is significant. Of course, no forecast is without risk. A misstep from the Fed could derail the recovery. The AI boom could decelerate faster than expected. We could see a wave of corporate downgrades, or the consumer could finally show signs of stress. These are the key macro triggers to watch. But for the prepared investor, the path forward is clear. Here is your playbook, rapid fire. First, overweight US equities, with a specific focus on those OBBBA beneficiary sectors and carefully selected AI names. Second, look beyond the mega-cap tech stocks to the Capex-driven beneficiaries that will power the next leg of growth. Third, focus on earnings per share revisions. That's where the real story will be told, not just in broad macro signals. Fourth, monitor credit spreads closely. They are your best leading indicator of risk. And finally, prepare for volatility, but position your portfolio for the significant upside coming in 2026 and 2027. 2026 isn't just another year in the cycle. It's the year where fiscal power, a broader profit engine, and transformative AI spending converge. The investors who position early will capture the shift.